As we look ahead to 2025, it is important to consider Ireland's evolving tax landscape amidst a number of global shifts. Domestically, key developments include the introduction of a participation exemption for dividends, representing what we consider to be the final piece of the jigsaw in Ireland's holding company regime. Also, likely improvements to Ireland's investment funds offering on foot of the recent Fund Sector 2030 report. We also expect changes to Ireland's interest deductibility rules on foot of a consultation on the tax treatment of interest. Ireland will have a new government in 2025, which will inevitably mean some degree of change on domestic tax policy, but the key features of our corporate tax system relevant to multinationals operating in Ireland are not expected to change. On the international tax stage, uncertainty has increased. In the US, potential changes under the new administration, such as renewed trade tariffs and changes to corporate tax rules, could significantly impact the global economy. Cuts to rates have been signalled by President Trump's campaign, including a potential cut to 15% for companies producing goods domestically. For US multinationals operating international headquarters and other operations in Ireland, this could represent a material change. The OECD BEPS two-pillar solution continues to face challenges. Negotiations on Pillar 1, intended to reallocate profits to markets, remain largely stalled. The prolonged delay in its introduction means that digital services taxes, which work to target in-country gross revenues of multinationals, may resurface. Meanwhile, Pillar 2, the global minimum tax of 15%, is now in force in the EU and select other jurisdictions, including the UK, Australia, South Africa and Japan. Interestingly, President Trump's campaign threatened retaliatory tariffs for countries participating in Pillar 2. Whether this comes to pass in 2025 is unknown, but it certainly introduces complexity. Turning to the Irish economy, conditions are strong, with a favourable investment climate. This is fueling growth in M&A transactions and related financing activity. While Ireland's economic growth prospects remain strong, we must acknowledge and prepare for potential headwinds, including global tax and geopolitical volatility. However, Ireland remains consistent in its corporate tax policy and regime, including its alignment with the OECD BEPS framework and EU anti-tax avoidance rules. Ireland continues to be a trusted and reliable destination for international business and investment. For more guidance and expert advice in 2025, please reach out to a member of the tax team at Mason Hayes & Curran. Thank you.